Jonathan Lemco is a principal and senior sovereign credit analyst at the Vanguard Group, which has about $1.7 trillion in assets under management. He joins us now from the firm's headquarters in Valley Forge, Pennsylvania, with more. Jonathan, great to have you here on Fast Forward. It does look as if a default is inevitable. Certainly when you look at the credit markets, that's what's being priced in. But and you agree with that, but you say there's a big difference in the type of default. So I was hoping you could clarify that.
Right. I think that it is likely that if and when Greece defaults, it would be orderly, orchestrated in large part by rich Europe. But there's also a risk that it could be disorderly, come as a surprise when it does in fact happen, catch the market, catch Europe by surprise. That would be awful. I don't believe that'll happen, but it could. We're kind of in unprecedented territory right now.
Jonathan, what would a disorderly, though, default look like? How, at this point, could they surprise anyone? It seems to be in focus there in Europe, even if it falls off the headlines momentarily over the last several weeks. It certainly has been the focus there in Europe. So how could it come as a surprise to anyone at this point?
In the sense that it happens sooner rather than later, that they just decide, we don't have the monies anymore. We're not going to be able to impose austerity plans the way we've said we've been able to do it. We're going to stop. We're going to take our chances and default and still remain within the Eurozone as well. That's how it might happen, as opposed to pronouncements from senior politicians in Europe saying there's going to be a schedule in place, we expect to happen on such and such a date, and so on. And that seems to be the direction we're heading, is that senior politicians and senior public servants within the ECB and elsewhere saying we're going to have it in an orderly schedule, if you will. Greece could surprise us still and saying, by the way, we just don't have the funding, we're done.
So,
I don't think that happens that way, but it might.
There's a busy calendar for Greece. I'm just looking at this timeline here. September 23rd through the 25th, we have an IMF meeting, right, in Washington.
Yes.
And then right around that same time, Greece has a $2 billion Eurobond that matures. Is that when the surprise would come?
It could. I've done a run of the numbers. It looks like Greece has enough monies in place from outside, really, to see it through much, if not all, of October. But nonetheless, they may choose not to allocate it in the way the market would like. And if that's true, then that would be a default right there. Again, I don't think this happens at the time of the IMF. I think they can go longer. They're going to plead for more and more to see themselves through the end of the year. It is possible they'll, in fact, get that. Although the public, particularly in Germany, is so opposed to that right now, overwhelmingly opposed. That's going to be a tough political call for Germany.
What about the other countries throughout this region, Jonathan? I mean, we've talked a lot about Italy, Spain, Ireland. Which of these countries, Portugal, do you think are most at risk in the event of whether it's an orderly or disorderly default by Greece?
I think Portugal is next in line. I don't believe it defaults. I believe it muddles through, but it's going to be very, very close. They're not nearly as bad off as Greece. Greece is maybe 3 standard deviations worse than anybody else, but Portugal would be next. The macroeconomic indicators in Ireland are actually a little bit better than they were before. And so it's improved from the way we looked at it before. All those 3, however, could be allowed to default at great cost, and the Eurozone, the euro currency area, could continue. However, I think Spain and particularly Italy are too big to fail and also too big to save. So in the event that they run into much worse problem than they have already, I don't think it's likely, but it's possible, such that they come at risk of default, then I think the whole experiment is done. Italy's the 3rd biggest economy in the Eurozone. Spain's the 4th biggest. They're too big to be supported in any meaningful way by Germany and the Nordics, Netherlands, and the other rich countries of Europe.
All right, Jonathan, unfortunately, we have to leave it there, but it's interesting to hear you say too big to save. You know, too big to fail seemed to be the expression of 2009. Too big to save seems to be the expression that's being used more often here in 2011. Thank you, though, for joining us. Appreciate the insight. That was Jonathan Lemco of the Vanguard Group, head of their sovereign. He's their head sovereign analyst there, giving us some insight into who's likely to default or who's likely to fall after Greece. We'll come